Bloomberg Audio Studios.
Podcasts, radio, news.
Joining us now for more, Goldman Sachs chief economist Jan Hatzius. You know, you have the IMF for the U.S. alone reducing growth and increasing inflation expectations. You have the president of the United States really pushing the Federal Reserve to cut interest rates and threatening here Jay Powell's job. Do you think the Fed does, in fact, have room to cut interest rates? Is there a case for that to happen, given the inflation concerns?
It's complicated because clearly the growth outlook has deteriorated very significantly on the back of these tariff announcements, and we've downgraded it by more than the IMF has. We're looking for only really barely positive growth in 2025, 0.5% fourth quarter to fourth quarter. But at the same time, the inflation outlook's also deteriorated, and we're probably going to get back to the mid-threes, if not higher, for core inflation. So I think the Fed's going to probably take a wait-and-see attitude, at least for the next meeting, because I think at this point it's unclear what is going to win out. What are the drivers of the ultimate decision? I think number one, do we see a significant deterioration in the labor market, a significant increase in unemployment? That would make cuts a lot more likely. And then number two, what do we learn about inflation expectations? Do they stay anchored? And I think if you see deterioration in the labor market and pretty good inflation expectations numbers, then I would expect some cuts before too long. We have three cuts, 25 basis points in June, July, September, but that's going to really depend on the economic data.
Right. So there could be a case for cuts, but it sounds like it doesn't quite exist yet. I want to get your thoughts, Jan, on another story that's been developing over the past week or so, and that is that Trump reportedly talking in private about options, what it would look like if he could remove Jerome Powell from Federal Reserve chairmanship. And I'm curious what you think that the reactions specifically in the Treasury market would look like were that to happen.
Well, I think we've seen it in the last couple of weeks when that has come up last week and then again over the weekend and yesterday. We have seen a significant tightening in financial conditions with increases in bond yields and declines in equity prices and also weakness in the dollar. But from net, it has tightened our financial conditions index whenever that has come up. And so I think that gives you sort of a foretaste of what would happen if we really did go down this road. There are a lot of legal issues around this, and I'm of course not a lawyer, so I don't know what the ultimate adjudication would be, but it is clearly something that has had a significant impact on financial markets.
I want to ask you about Torsten Slok's forecast, 90% chances of what he calls a VTRR, a virtual trade reset recession. He notes that 80% of U.S. employment and 85% of CapEx comes from small businesses, and they have a much tougher time dealing with these tariffs. He says expect to see ships hit offshore, orders canceled, and well-run general retailers file for bankruptcy. Why aren't you as concerned as Apollo's economist?
Well, 90% is a very confident view on almost any outcome. I don't know if that refers to the standard definition of a recession, which is really the National Bureau of Economic Research determination. On that basis, we're at 45% for the next 12 months, which is definitely a high risk of recession. It's practically a toss-up, but I think the questions at the moment are, do we see a weakening of the hard data that is similar to what we've seen in the soft data? What's going to happen to the average tariff rate? And I think the pullback that we saw on April 9th does give us more of a chance of avoiding recession. And how big of a tightening in financial conditions do we see? There was a very rapid tightening between April 2nd and April 9th. Some of that has unwound. So it's definitely a significant growth drag, but whether it's a recession, I think it's a little too early to tell.
But can I just just to double down on Shonali's first question then, why doesn't Jerome Powell cut rates now? If the soft data looks this bad, don't you want to stop it from solidifying into really bad hard data? Wouldn't a rate cut, a preeminent rate cut now, be the right move from the Fed?
That would be the argument in favor of a rate cut. The argument against would be that you also wouldn't want the very likely increase in inflation to harden into second round effects and ongoing higher inflation. That's the other side of the mandate. And I think at this point, the Fed is not going to be preemptive, but probably more reactive because they need answers to those questions.
Yeah, and we were speaking just a day ago to Claudia Sahm, and one point she seemed to make here was that if the Fed does cut interest rates here, does it look like political pressure? The issue that might be being created right now with the president's pressure on the Federal Reserve is politicization of the Fed, therefore the Fed's credibility. Do you think that this has the potential to create some crisis of confidence, frankly, in an institution that has been the backstop of this market for now, you could argue, the better part of a decade, at least?
Well, it certainly raises risks. I think the way to address those risks, if you're sitting in the FOMC, is to really be very clear that they're focused on the data and take into account what's happening in terms of the growth outlook and the labor market, but also look at the inflation outlook. I think, you don't want to cut because of political pressure, but at the same time, you also don't want to, refuse to recognize reality. If the way that the outlook breaks is that we see, a really significant deterioration in the labor market, then I think they should respond to that, and I think they will respond to that.
Let's talk a little bit more about Fed independence, because let's say that Jerome Powell stays on for the full length of his term, May 2026, but the genie's out of the bottle here, Jan. We know that political pressure exists, even if Trump doesn't take the ultimate step of removing Jerome Powell. And I wonder, when we get that next Trump appointee to run the Federal Reserve, what does it look like when you think about the board holistically? Is it possible that we see more dysfunction, more dissents when you think about the future of the Fed?
Well, I wouldn't call dissents dysfunction. I think it's actually quite normal to disagree, and we've had dissents over the years. And if you look at other central banks outside the U.S., it's actually much more common to have dissents, and I don't think there's anything wrong with it. So I don't worry about as much. Now, we of course have to look at how the Board of Governors evolves. And of course, there's also the Reserve Bank presidents. The FOMC is 7 governors and at any time 5 Reserve Bank presidents. So it is an institution that has, quite a lot of institutional stability, even in an environment where the president gets to appoint a new chair and new governors. But it takes quite a long time. So I think there is there are some significant safeguards built into the system, and I certainly don't worry about dissents very much.
Yeah, and I spent a lot of my time, I started my career covering investment banks here, so the restructuring advisors are the ones that I'm calling the most these days. As an economist, how do you see the economy weakening? Where are you sharpening your pencils the most to see that fall off the cliff that we're standing on?
Well, in terms of sectors of the economy, I think you want to look at, number one, what's happening to consumer spending as real incomes decline, as prices rise, and that eats into real income on the back of the tariffs. I think that's going to happen over the next few months. And then number two, business investment. I think you're particularly going to be focused on the uncertainty effects, the potential for firms to just wait it out until they have more clarity. So high-frequency capital spending indicators are going to be helpful as well. I think there you probably do want to focus pretty closely on surveys of capital spending intentions because the hard data are very lagged and you're not going to learn in time what's going on. But I think those are really the two areas that are probably most important. Obviously, the trade data are going to be important, but they're going to be enormously volatile because of pull-forward effects and and then changes in trade flows. But for the domestic economy, it's really consumption and capex.